Hi, I'm Michael Lebbon. I'm the co-founder and CEO of a company called Emmy, and we're basically a company full of climate and financial experts that have basically partnered with FactSet to co-develop a climate risk data and tools solution in market. And we provide transition risk, physical risk, and emissions data for asset owners, asset managers, and banks to help them quantify climate risk and do something about it. Yeah, so the way we see mandatory climate disclosures sort of playing out is realistically, they are asking investors to disclose the tail risks. So they're asking them to say, what is your exposure to a very, very sharp transition? So say a 1.5 degree world and also a 4 degree world. Now that is, when you talk to most people, unlikely events to happen. But what this does is it actually, the way we see it is this is creating the attention and the resources people need to quantify what those tail risks are. And then once they've done that, they're then saying, okay, well, that's our regulatory sort of stress test. But now we've actually got the data and the resources. We then are going to think about how we can utilize the data we have now and the framework to then start pricing in our expected risk and our expected, what we think companies are going to do, and, maybe going to more the 2 degree world. So we're sort of seeing mandatory climate disclosures on themselves, possibly not really pricing risk as such, because they're so far up the tails and sort of people don't necessarily believe they're the scenarios that are going to happen. But it's creating that momentum and that baseline to then allow people to say, okay, I understand how I've done that. Let's go and translate that into an expected outcome. And that's where we see that's going to start, pricing risk. Yeah, so what we're seeing in the market is there are some firms that just want to tick a box. There'll always be those firms, but because mandatory climate disclosure, this is a big uplift in reporting. It's basically the biggest change in accounting framework since, IFRS actually created globally and changed, and we had GAAP accounting. So because it's taking so much time and effort, and it's now dragging in and pulling people from that work traditionally in climate investing or responsible investing, it's pulling in CFOs, CIOs, accountants, finance functions. What it's actually doing is you could just do the bare minimum and, say, for example, it's going to cost you maybe 80% of, a budget. But if you actually do it properly and say, well, because we have to do so much work, it gets us over that initial hurdle. And then the marginal gains, the marginal costs and effort to then go, okay, well, let's actually think about how we can then make this decision useful. It's not that much more because you've already done all the hard work to get to regulatory perspective. So this is where we see the leading firms turning this into a competitive advantage, saying, well, we've got to do the bare minimum, but we see regulation as the baseline, and then utilizing this to then say, okay, what else can we do with all this extra data and frameworks we've now spent time doing to then basically start integrating this into our investment management frameworks. And you've now got people, this is now taking climate into the mainstream. So that's how we see that sort of getting that ability to then think about how you can use this to generate alpha. So once you can standardize climate risk, and you can standardize it properly, the way we talk about it is instead of going to a portfolio manager or an investment committee or something saying we are currently 2.5 degree aligned, which is what used to happen that was sort of where climate analysis was a few years ago. I'm 1.5, I'm 2.5 degree aligned and all this. You tell that to a traditional risk person or a portfolio manager, that's not been involved in climate, they do not know what to do with it. It's like, okay, cool, that's nice, but what do I do with that information? How does it speak my language of financial risk and return? So with standard, if you can generate and build a standardized risk model utilizing the correct data, what you can actually do is you can talk the language of the investment community. And actually, so instead of a 2.5 degree, 2 degree, 1.5, 3 degree aligned portfolio, you can start saying, across our portfolio, we see climate as potentially creating maybe a 1 or 1.5 degree, 1.5% headwind year on year because climate, if this scenario is to take hold. Now, that doesn't necessarily mean that's the only thing you look at. What you can then do is you can take that information and marry it to the other investment risk factors, so inflation, credit, market risk, etc., and say, well, how does climate start affecting it? You might have a climate headwind, but then there might be other tailwinds, and it's like, well, it's going to help me understand how I think, but it's not the only thing that you need to take into account. But what you can do is you can now move climate out of the ESG responsible investing sphere and actually go, this is just investing, and it is just something that we take into account in our normal processes. But the important thing is you need to have justifiable, quantifiable, standard data and risk models. Yeah, that's a great question. As I said in my presentation, you ask 10 people, you get 10 different answers as what an opportunity means. Traditionally, people were thinking about opportunities, and again, this was going back 2 or 3 or 4 years ago when the data wasn't as robust and as mature as it is now. We've obviously got more to go, but they were really thinking about divesting and avoiding carbon risk or climate and transition risk. Whereas now, more and more people are starting to think about, well, how can we maybe finance the transition and like hold a company through its transition pathway and actually invest in the big emitters and get them to decarbonize. Now that, without solid data and being able to say, look, this is how I think this company is going to de-risk, and I can quantify and explain this is that process, you're going to have to be, you're going to have a difficult time explaining why you're going to take this extra risk on. Whereas, so we are starting to see some clients go, well, if I can justify and quantify the, let's say BP, for example, just to pick an oil major, we looking at what we think they can do going forward, and we can sort of chart how they can decarbonize, and we can quantify that level of risk reduction. Well, if we think that's going to happen and we can prove it, there's actually potential alpha there, because if all things being equal, if you hold the company through its transition, you shouldn't pick up, because it's reducing its risk, you should pick up extra performance. But there's no point waiting for VT to decarbonize, then buying it, because the price will have already appreciated once the activities perform. So that's one aspect. Others are, some people looking at physical risk as potential adaptation plays. There's a bit of contention as obviously adaptation is needed. There is a little bit of contention in the market that some people that actually created the physical risk are now going into the adaptation game, and it's like, well, there is potentially opportunities there, but there is some people are talking about moral hazards there, because you created the problem, now you're selling something to solve a problem that you created. And then there's also looking at, you can look at green revenues and green capex, or you can look at carbon credits. There's lots of different things you can look at, but the one, I guess, that we've, from a quantifying a risk perspective, is really looking at those forward-looking and how do you quantify that expected decarbonisation part and how that lines up with particular scenarios. Yeah, so we see this as really, first of all, it's getting a shop in order. There's a lot of education that needs to go. It's not just, the responsible investment teams or the ESG teams anymore. It is basically the whole organization is affected by this. So you're going from, to portfolio managers, to risk managers, to CIOs, investment managers, CEOs, directors. They all need to understand it. But the first thing you've really got to do to get this up and running is educate people that haven't been in this space. Because they will often look at an IPCC 1.5 degree scenario and go, that's just out of this world. Those numbers are too high. That risk is too big. And instantly lose credibility. But that is actually what we've got to remember, IPCC 1.5, moving from 36 billion tonnes to 20 billion tonnes overnight. There's going to be massive issues and systemic repricing going on. But you need to first of all basically educate. So you need to set a really good baseline with your stakeholders to basically get them to buy in, to say, okay, we understand why their issues are, what the issues are, how we do it. And then once you've got that buy-in and established education and sort of confidence across the team and across the organization, then it's about getting the consistent data that tells your story across your asset classes and then integrating it. Gone are the days of Excel spreadsheets. We need to integrate this into our portfolio management workflows and basically have something where you can extract the data straight out of your portfolio management system to then generate your mandatory climate disclosure data reports, which then feed into the narrative that you need to write, ideally encapsulated in one system, which then you can take that same data and then integrate that into your investment management system. So it's thinking about setting up to get into a foundational data source that can do regulatory reporting and investment management. But realistically, before you jump into that step, you need to make sure you've got buy-in and people understand what climate is, because us as climate risk and climate finance practitioners that have been doing it I've been doing for 2 decades now, you take for granted that not everyone necessarily understands this. So you need to spend time getting people to understand it, because once you've got that baseline understanding, then you can move so much faster and get things signed off and move. And that's what we're seeing the leading firms do.